Fixed index annuities are intricate financial products that will typically link the interest that's credited to your account to an index, a market index like the S&P 500, without directly investing in that index. Insurance company will offer the investor different crediting methods, which will give them the option to limit their losses while also participating in some degree of upside. The insurance industry writes a lot of these products, so I felt like it was a good topic for me to explain how the insurance company gets paid so that you, the consumer, can make a better, more informed decision if it's something that you were considering. My name is Michael Carbone. I'm a financial planner and a money manager in Greater Boston. I work with pre-retirees and retirees nationwide to help them to ensure they're doing everything they possibly can to minimize their financial risk and put the odds of long-term success in their favor. All right, so let's spend just a minute or two just reviewing what a fixed index annuity is if you're not familiar. So a fixed index annuity is an insurance contract that investors can purchase to try and grow their money. The interest credited to you on these contracts is typically linked to some underlying index or combination of market indexes. The idea behind this type of insurance product is that investors can participate in some of the market's upside while also controlling how much money they can lose if the market does poorly. Sounds great, right? But there are no free lunches. And the problem with these products, in my opinion, is that there are no direct line items that you can see what you're paying, what the cost of the products are. It's almost always baked into the potential upside that you have in participating in those markets. So in other words, the cost of these products, the main cost of these products, is in the form of an opportunity cost to investors. All right, so how do insurance companies make money by selling consumers fixed index annuities? Unlike most traditional annuity or insurance products, the fixed index annuities don't typically have a mortality and administrative expense, which is the more of the line item expense that you would expect to see when you buy an annuity. Instead, the insurance company will typically earn a profit by investing your premiums, by selling additional guarantees or riders, and then of course by charging early surrender penalties. All right, so here's a general overview or an example. Say that you give $100,000 to an insurance company to purchase a fixed index annuity that has the potential to earn up to a 6% return in any given year without any downside risk. So if the market goes up by 6%, you get 6%. And if the market goes down by 20%, you get nothing. So you give the insurance company that $100,000 to buy that strategy that they're offering or that product that they're offering. They'll then take that $100,000 and pool it together with other consumers that gave their money to purchase a similar strategy or the same product. They'll then take all that money and invest it in a separate account. And within that separate account, since they're on the hook if the market drops, and they guarantee that they would cover your losses, they'll have to buy portfolio insurance to limit their downside. So they'll buy insurance that pays off if the market goes down, and then they'll also have investments that will increase if the underlying market index increases. So from a high level, as it relates to a fixed index annuity, the cost to the insurance company to sell these products, in addition to marketing and all that stuff, the cost to them are the interest that they're crediting the accounts and the cost that they have to pay to insure themselves against the losses to whatever extent that they're guaranteeing they'll absorb those losses. The revenues that they're earning are coming in the form of the investment returns that they're earning from investing those premiums, as well as the the extra guarantees, the riders that they're selling, and early surrender penalties. So if those revenues that they're earning exceed what their costs are, then they earn a profit. And again, this is a very high level, so this isn't everything, but generally speaking, with the fixed index annuity, this is how the insurance company profits. So when I was going over the cost to an insurance company, when it comes to these fixed index annuities, I sort of dismissed the the marketing costs, and I think this is also something important to be cognizant of, because when the insurance company distributes these products, they're doing so generally through an intermediary, like a financial advisor, and that's a marketing cost. And the reason why I'm bringing this up is because I've had a number of clients who've come to me and told me that they had a financial advisor who told them that they don't pay the financial advisor a commission to sell it. It's the insurance company that pays the advisor, and it doesn't come from the client's money. And this is a misrepresentation of how that works, because although it's not something that you see as a as a line item, like I said before, these costs are baked into the product, and I can tell you with confidence that the insurance company is going to profit. They have it figured out. They set those caps, and they have a relatively high level of confidence that they're going to earn more money than what they're paying out in interest and the cost that they have to insure those products. So that is not, so if someone says that to you, if you're considering, buying one of these products, then you should probably run away, because that's just not true. And it's, it's unfair and not balanced to say that, because although you're not paying a direct commission to an intermediary that's distributing this product for an insurance company, you are paying for it in one way or another. So you might have noticed that the general undertone of this video has been, relatively negative, and I kind of presented fixed index annuities in a negative light or a bad light. But that's also not fair. I think that these types of products do offer, some benefits to some people in certain circumstances, but at the same time, I just feel like they are, sold in a way that isn't representative of the true benefits that they may, or they can potentially offer to the average investor. You're getting stock-like returns with no risk of losing money. When in reality, the more realistic or likely outcome for the investor is that they'll earn a return that's more commensurate with a corporate bond yield. And what's more, these products are essentially a corporate bond. These all these annuity contracts and premiums that you're paying, they're a liability of the insurance company. So there is an element of credit risk, and so an investor that's accepting that risk should be compensated and get some premium above what they could get by lending their money to the government. Anyway, annuities can be good, they can be bad. But if there's one thing that rings true, it's that they are incredibly complicated. So I don't think that they should be dismissed altogether as a means to managing your longevity risks or providing some sort of predictable income. I just strongly suggest that you consider them cautiously and exercise your own due diligence, and to consider them more through the lens of risk management and not investment growth. I hope you enjoyed this video, and as always, I've included a link in the description of the video to a complimentary consultation if you feel that you would benefit from having a call or setting up a Zoom meeting with me to discuss your own financial situation. I wish you the best of luck, and I hope to hear from you soon.